Today is 22nd of September, a day after the Fed meeting. The market is moving downwards. S&P right now is around 3750 level. QQQ broke the support of 282, now is around 278. And it looks like that hell is breaking loose. However, the VIX is not above 30, it's around 27, below 27. And the key points are why the markets are moving is because of the treasuries. US 2-year broke the 4.1 barrier and it's above it's around 4.15 now, whereas 10-year sharply moved from 3.5-ish to 3.69. It hit a resistance in the last half an hour at 3.69 and now consolidating around there. Stocks work in tandem with the bonds, as we know. Everything today is indicating that the market is going to go down further. 3,700 was never a good support level. It was always 3,800 and above. So it's probably going to go towards tomorrow to 3,600 level. And tomorrow we'll test whether we're going to break 3636. If it goes to 3600 level tomorrow, then it's going to very sharply fall. It's not going to wait till the next week to check whether we break 3636. It's going to test tomorrow. But it's the key is that how Apple holds up. Right now, it's interesting that although we are very close to the 3636 level, Apple is still hovering around 150. It's very strong at 150 for the last couple of weeks. So really the key for the market is how Apple holds up. If it breaks the key level, the 3740, it already broke that level. If it actually continues to break that, in the trend line, 3740, then I would think that Apple will be further down and it's going to go towards the 140, and then we're going to see a very further acceleration towards 3636. I do not think it's going to go further down. Now, if you look at the 10-year and what the stock PE should be, 10-year versus the PE. So 4.6 around this, above 4%. 10-year treasury was back in 2006. Around the time the market was booming and PE was around 17.6 S&P PE. And since then, the US 10-year went down. As we all know, it's around 0 around 2020. And accordingly, the PE went up. The market multiple actually was around 20 or above. So the point is that at 4.6 in 2006, when interest rate was still kind of constant, then the market multiple was 17.6. Now we are at 3.7 level, 10-year treasury yield, and 2-year is around 4.1. Now that's like a inverted yield curve, so that's kind of a concern. But even let's say that in the recession is not here for another 6-7 months, people are not going to sit here and wait until the recession comes. They are going to buy the dip, and people are going to judge the market based on the current multiple, what the earnings kind of will project. Now, if the October earning comes out to be okay, then market will shoot up, and it's not going to go down. So 3636, people, as much as people say that 3300 is a bottom, nobody's saying the bottom is going to come tomorrow. So people are going to cover their short. So as soon as we are around 3600 level, we're going to see a lot of short covering happening, and we are going to see a pop in the market. So it's very difficult to short the market right now, and although the valuation is really good, it's hard to say that we can buy. But one strategy which is sort of might work, and sometimes you might get unlucky, is to sell put in this in the high premium you're getting in this volatility, way out of the money, and sell put quite a bit if your leveraged account permits that. So just going back to that point of what's the right S&P number. So if you look at, like, right now, the S&P earning is around 215 for 2022. And, if we go back to last instance of 4.6, I'm giving an example of the 4.6 10-year because the the projected Fed fund is 4.6. So the 2-year is going to go towards that 4.6 if they believe that the Fed will, keep up with that promise of getting the Fed fund to 4.6. If 10-year, is a trailing end for the 2-year, then 10-year will go towards the 4.6. Let's say 4 or 4.1. So then the question becomes that if the 10-year, which works in conjunction with the S&P multiple, if the 4.0 or 4.1 is your 10-year, then what is the right multiple for S&P? And as I said, in 2006 and in the prior cases, the S&P was never 17 or below, when even when in all other instances 10-year was further up. Back in 1990s it was around way above 4%. It was close to 10%. So you don't get in many examples where 10-year would be above 4%, but there's one instance in 2006 where it's around this area, so around 2004 2006ish. So at that time the S&P multiple was 17. I would say that 17 is the right multiple, is the lowest multiple it can go in the recession, and normally it should be 20. If you take 17 multiple and multiply by the no earning, there's an earning regression but no earning growth even in the next year, that is around 215, you still end up around 3,800. So we are around 3,750. So S&P right now, I think is priced in for recession. I don't think that is going to go to 3,300. I think it's going to be bought back heavily, at least not in the short term, heavily, as soon as the October season comes. So if you are way underwater, I would not short the market right now. You could potentially sell out of the money puts, just make some income. You could potentially sell calls against some of the stocks which recently moved up. For example, Netflix is one of them, which with very little news, it went up to 248, and then it sharply went back to 230. So I sold call for the Netflix yesterday at 250. QQQ, I think it's a good idea once it hits the 277, which is a pretty strong support for QQQ. Probably to sell out of the money put at 270 or buy calls or sponsor the risk reversal, sponsor the call using selling the put. S&P, I won't bet on S&P at this point. I definitely think that the Fibonacci retracement, considering the lowest of 3666 and the highest is 4326, which we hit back in August. The next Fibonacci retracement at 0.31 is 3740. The last one is around 3636. So 3740. If that level breaks today, it should break today. If it happens, very convincingly, then we're going to go to 3636. Tomorrow. I think it's going to be tomorrow. But if you hold up that level, it's probably going to be next week. It'll be very tumultuous tomorrow. So if it holds up today, market is going to go up a little bit tomorrow for a relief rally, I believe. In that case, I would close any possible positions that I could given the situation we are in. So we are definitely going down for a little bit for short term, but in October, as soon as the JP Morgan will be the first one to report in October, just around the time, I think banks will be bought back, some of the other stuff will be bought back. So from the lowest to around to not to the August low or September current low, but probably would be close to if you look at the 3900 S&P, what was the level of the stock? Probably around that time, around that range, the stock will go up. So that's my take right now. So we'll see how it goes.